they soon realize that they need an asset manager or somebody's expertise who's done it before because they can't do it all themselves because there's so many moving parts that they
Yeah,
are spread too thin.
absolutely.
We become the catalyst for growth.
In this episode, I talk with Andrew Pope. Andrew is a highly experienced senior asset manager with expertise in all major components of commercial real estate investment. Since 2014, he has been a part of over $1 billion in real estate transactions. We discuss what is asset management and why it's such a vital component to your investment strategy. What are the common mistakes that asset managers make in multifamily? And how are asset managers adapting to this current market? I hope you enjoy. Now here's the show. How's it going, Andrew?
Pretty good. How about you?
Good, good. Glad you're able to come on today. I want to talk about something that's probably one of the most, well, maybe it's hard to say the most important, but definitely a vital component to investing in real estate, and that's asset management. And really, whether you're in, and maybe we'll get into this in a minute, whether you're in multifamily or commercial or single family, asset management's always involved. But for those who don't know what asset management is, can you explain what that is and maybe how it differs from property management?
So, asset management is looking out for the owners and the investors for risk and cash flow and making sure they get the returns as represented to them. So, in a nutshell, I used to say revenue minus expenses equals NOI, and then that gets split and that affects the valuation going forward. So what we're trying to do is enhance and improve and protect the cash flow and the sales price in the future that was shown to the investors. And then that way, the ownership is able to carry on, do business again with those investors, and hopefully look good in the process. And it's doing what they say and protecting the pro forma that was originally done.
Okay, so how does that differ from property management?
Property managers are hired for a fee. They typically do the leasing, the collection, and pay the expenses, and sometimes have the accounting. So what they're doing is a vital service to the property. They provide staffing, that being leasing, representation on the property, and maintenance. And so they provide the team and the customer service, and they're kind of the sticky part, the human part that keeps the tenants there, if that makes sense.
Yeah, and so they're the boots on the ground, whereas the asset manager is making sure that they're doing their job. Does that sound fair? And executing
Yeah,
the
so
plan.
yeah, the asset manager is there to review metrics, make sure the financial performance matches what they are saying and that they are performing their work and providing the focus needed for that particular asset and working behind the scenes on renovations and coordinating that with new tenants. Property management typically writes the leases for the tenants, and they pay the bills for expenses to take care of the property while they're there, and they are the representation. So sometimes they stray outside of that, and asset manager's job is to bring them back into focus so they are able to perform on their core competencies, if that makes sense.
Yeah, and anyone can be an asset manager, or I guess right when I saw that phrase, and I was kind of really trying to distinguish what it was, and you really described it very well. But it kind of hit me. It's like if you had a single family property, because usually this term is in commercial real estate or multifamily. You don't really see this term unless you're talking about big portfolios of single family. But really, if you own a single rental property, and that property is being managed by a third party management company, you're an asset manager. It's basically what you are because you're making sure the property managers, or I mean, you should be at least. You're making sure the property managers doing what they're supposed to be doing, right?
Yeah. So a lot of owners start out doing their own asset management because you operate it as an owner, the same concerns. And then once they reach a certain critical mass, a portfolio where they are spread too thin, they need somebody to kind of help get them to the next level or to peel off their responsibilities. They can go to a property management or an asset management person who oversees a property management company and it's a duplication of themselves in a way. So at a certain point with portfolios as they grow, asset managers become it's a hard handoff for some owners, but it is a point where there's an asset management fee, and then that fee goes to pay an asset manager to take over rather than the owner doing everything themselves, being hands-on. So
Yeah.
you can
And it's
say that
ultimately why, like, going back to single family, just, I mean, most people involved in real estate they're involved in the single family side. Um, it's why real estate rental properties or single family rental properties, they're not truly passive. I mean, they definitely have passive natures to them, but at the end of the day, you're always actively, even if you're not property managing the property, you're actively managing the asset. So you're an asset manager, which means, like, at the end of the day, the buck still falls on you to solve some of the critical problems that can come up, unless you bring in an asset manager and you build a portfolio and you bring someone in, then it can be a bit more passive. Does that sound right?
um, correct. Yep. Asset managers have the same, how can you say, task list as most owners. They're concerned with meeting the pro forma as it was underwritten, which means that there's rent growth typically, making sure that the occupancy is up and happening, and who's accountable for that? That would be the property management company, and making sure the taxes are paid and the bills are paid, and knowing the details under the hood so that they can act on behalf of the ownership.
Yeah.
So, and then they also report back to the owner and their investors and provide, let's say, the market and what's going on. But typically, they're brought in when the portfolios are big enough that the owners can justify paying an asset manager for their services.
Mm-hmm.
So, institutional people, it's a must. There's a football team of asset managers typically, and the portfolio is broken down. Call it gearing ratios. This is for debt, equity, and ownership. I've managed up to 30, 40 properties. But then again, it matters what the tasks on a daily and monthly basis are. But large institutional owners want the asset managers to touch their asset at least 2 times a month and make sure things are going per plan. And the ones that are in development or lease up or new, they require being touched every day. So it varies on the type of asset there is. So it is a mixed bag, and there's various definitions of the term, what it is. You just kind of have to look and see what is needed by the ownership.
Yeah. And from an asset manager standpoint, you mentioned 30 properties or so. Is that 30 like multifamily communities, or is that 30 like single families or?
Um, yeah, so I worked for AIG Sun America and MMA Financial. They did equity and debt for multifamily, some affordable, some market rate. And so they had total company wide, let's say 150 in process at any one time. And each asset manager would take on about 30 if there was a construction component because it took more hands-on work. Once they become stabilized and cash flowing with a stabilized loan, those asset managers handled up to 70 and 80, and it was all automated and checks and balances, making sure that things from the ownership side were taken care of. And that's kind of an extreme case. 70 to 80 is a big load. So younger, that right now there's a lot of upstarts in ownerships, and the portfolio sizes of less than 10. Those owners are, let's say, 10 single family rentals. That's about the time when you bring in an asset manager because they're looking for growth. And the
Mhm.
asset manager is a growth agent where you can automate and get things all pulled together and the quality of data and pro formas, and they want to acquire more. So asset management tends to dovetail and overlap with acquisitions, and it dovetails and overlaps with accounting and all the consultants and the tax base and getting the growth plans and the NOI growth from year to year to happen with certainty. So there's strategies to get that to happen, and we look at all of that. So it is a big topic, but there are various scopes and varieties of asset managers. You just have to ask the question how detailed and how experienced they are.
And it seems like it's like a dream job for someone who loves numbers, loves projections, loves seeing those play out, Excel graphs, charts, especially when it's tied to something that's real. that you could actually touch too, and something interesting like real estate. So
Yeah, so you have, yep. So you have to you have to see the forest before the trees. You have to look at the details and back up and see, is this going the right direction? And provide an overall strategy and course correction if need be for the property managers who may be able to see it, but in most cases they are very much, how can you say, very close to what they're doing and need some guidance and some
yeah.
strategy.
So how'd you find yourself in this field, and how'd you get started in real estate and find yourself doing asset management?
So I started out, I've been doing this, a variety of asset management my whole career. That's been since before 1989, but I started with a large life insurance company and we managed the risk mostly. But what they did, they had $1 billion of commercial mortgages a year operation nationwide, and then they had about 3 or 4 billion owned across the nation. And we kind of were in a matrix environment, and we kind of plugged ourselves into the teams per region. So I remember going to the West Coast one month and going to the East Coast the next month, do the on the ground work and then plugging into the teams under one roof that covered the nation. So it was really a, how can you say, a lot. So what it was just plugging into a team that needed your expertise and guidance because they were all about lending and they may not have known what the asset or the collateral was or the market conditions was. So we were to set them up for success and make sure that they could pull it off because we were they had less experience than us, but we had more specialized knowledge, and they justified. We had a whole group of them of professionals, mostly engineers and architects and so forth. And my specialty was construction management at the time, cost engineering, putting together cost estimates. And but we had environmental people, we had HVAC people, we had construction management, contractual people, and so we set up straight underwriters, straight finance people with the nuances of owning, let's say, an office building or a shopping center in Boston and getting them set up for success. And there's a lot of pitfalls and a lot of traps out there that somebody not knowing the terrain, we got them so that people would who had eyes and ears locally who would work for us and watch it while we were back in the home office, so to speak. So we had a big chalkboard, we were across the nation. Most outfits work regionally, let's say the southeast or in their city or metro area. So that's more specialized. But I've worked across the nation, and each market has its own story, its own particular set of risks, and we just were had the experience and knew what to look out for. But there's a lot of things that, how can you say, construction wise, property management wise, anybody who worked for a fee, there's human behavior behind that, and it's easy to see how they're going to behave based on their agreement. So we manage those folks as consultants, as service providers to the deal. And we put together, how can you say, the contractual agreements and made sure that we met with them and we had a connection with them and that they were working on our behalf, working for us instead of against us, if that makes sense. Anybody in real estate tends to know that you need to be careful if you're an absentee owner. So we facilitated that absentee across country type distance gap.
Yeah, it definitely requires a tight team. You can find yourself in a tight spot if you don't have that nailed down. And from a family standpoint, I never personally, I know people who do it successfully. I just the economics I never really found worthwhile. Multifamily, it's easy because it's a business. Um,
Mhm.
how are assets managers? How are they typically like in across? There's a lot of different. I mean, you can have an asset manager in pretty much any type of asset class, but sticking with like multifamily, like residential, multifamily, single family, how are they typically compensated?
So right now, the industry standard is that an owner or a portfolio owner would hire an asset manager. Their going rate would go anywhere between 90K a year to 200K a year with benefits, depending on experience. So there has to be a certain amount of critical mass in order to make that work. And then the asset managers have to extract the value, make sure that the assets are performing, and that the pro formas are cash flowing and that the investors are getting their cash. So
Okay.
we become the eyes and the ears, and we take the load off the owners. And we are kind of the glue that brings together the property management teams, the construction teams, and all the consultants involved, and get overlap and provide backup for underwriting, for accounting, and property management. So it's multifaceted. It comes down to foreseeing and getting out in front of the risk, because once you get into this business, you realize there are a few risk components that you need to be wary of. So a lot of it is you can learn on the job through experience. A lot of it is just knowing the numbers and having a good solid financial modeling, construction background. So I've touched on a lot of different facets there. So I guess the more value you can bring to your owner, the more value you are. So that's what I'm doing, is becoming a freelance asset manager and doing it on a fractional basis, talking to owners where they don't have to pay the full yearly cost or hire someone, but they can hire me on a fractional basis, like on a 2 month basis, project basis, by the hour. We'd like you to work on this for 6 months, train our team so we're better at it, and then we can take it from there.
Is that
So
like
I work
based
on
on
a Friday.
like a percentage of GCI or?
It really depends, because everybody's asset is in different states of ownership. Let's say they're in development and lease up. They just close on it, and they have to implement a value add plan. Well, things get pretty hands-on and pretty busy. So if it is something that is they have 10 properties that they bought, they're all 90% occupied, they're cash flowing. We just want to make sure that it continues on that way, meets budget.
Yeah.
That's a different set of things. So there's a life cycle component to understanding where you fit and what you're going to perform. So obviously one is different than the other and more time involved. So it comes down to an hourly basis basically.
Yeah.
But
I just know,
or
I mean,
what
I see how it's charged to investors in syndications and funds. And now, of course, the fund manager or the operator, they then typically have staff that they're paying to do this. So it's now there could be a spread. I don't know. It depends on the asset and the game plan. Um, but speaking of syndications, because that's definitely grown, exploded over the last 3 or 4 years. What what common mistakes are you seeing syndicators make in the asset management area?
So one of the most common things is making sure the investor comes out whole and gets a return. And a big part of that on value add is making sure they have the right renovation plan. And from month to month and year to year, they're getting new units delivered at a rent premium paid, and then that is the rent growth. Mostly it is how can you say, it's not organic rent growth, it is an accelerated rent growth per plan. And the most common mistake is that people don't deliver a renovation that tenants will willingly pay for.
So
So
their projections are based on a certain renovation, but the actual renovation scheduled is not meeting that quality. Essentially, is that kind of what you're saying?
yes,
Like
a lot of
they
times
want to
it's
charge luxury, but they're renovating only to a basic premium.
exactly. They want to make sure they're fair with their tenants, that they're delivering what their photos show. So I like to say that, okay, you build a nice renovation, you take photos of it, and then you put that out on the internet on your websites, and that is your marketing right there. You show a renovated unit, and then that draws them to the site. They're able to show up and touch it and see it, and then they can say, okay, I get a fitness center here. I get stainless steel appliances, a new top. It's basically new, even though the property is 1980s, and I'm spending, let's say, $40 less than I would if it was this brand new one right down the road. So this is a deal in my book because it's equivalent. So it is the owner's responsibility to make sure they're providing, that quality of unit for them to willingly pay the money for, and be honest with their tenant. So in a lot of cases, they're making a pretty big rent bump, let's say 150 to $300 a month because they bought it. An owner just basically cash flowed and did not pump money back into it on a new renovation. So they're making those renovations and they're catching up on the deferred maintenance and they're raising the rents to market and also making it economic for the tenants. So it's that equation right there that there's some shortcuts being taken. And let's say they hire contractors who don't perform and they get behind. Well, those are probably the most common mistakes that they make. And then that affects the NOI and the ability to pay debt service and the investment return on down the road. So you have to
Hmm.
get that component right if you're going to be in this value add business, and to get the new investment quality asset that everybody saw during the presentation. So it's the asset management's job to take care of that and see what can be fixed and what needs to be fixed, and to advise and tell them this is critical in order to meet your numbers. Take care of you and your investors right now. A
Yeah,
lot of
yeah.
times
Because
it
I mean,
takes,
I've always coached like the agents on our team and folks that are wanting to get their first rental property, and it's like, look, you can renovate it to any level you want, but you just have to make sure you're renovating to meet the comps that you're targeting. So if you end up pulling back on that, not being quite as aggressive, you want to, trim your budget down, that's fine. You can do that. Just know and understand that that potentially will impact the rent rate. And which, from a single family standpoint, may not be that bad. Maybe it could. From a multifamily standpoint, that's compounded times 50, 100, 300 units, which has
yeah,
a huge impact on the bottom line.
yeah, it's a big number. And in most cases, that is the yield, that is the return for everybody involved. And that's why they get into this. So, and in the process, what they're doing is positioning a much needed housing at a much better quality for the tenants, and at the same time hopefully they're giving saving the tenants let's say 40 50 bucks a month based on a brand new property. So you have to know your market, you have to know your tenants because they're paying the bills, they're paying the rent, and so everything you can do to take care of them and to gain trust from them, it will show in your numbers and everybody will walk away whole and happy, and the investors will get what they need and we're represented. So
Yep. Because that first
there's a
year
lot of
is so
gains.
critical because everything on years 2 through 5 or 7 or down the performa projections, everything is based on year one. So yeah, screwing year one up, even if you were like, it's pretty difficult to play catch up at that point. So it's just going to have a domino effect on the numbers that maybe you still do okay, but you're not going to hit your numbers.
Yeah. So there is a way to accelerate the plan and get ahead of it so that you are able to sell at your in your five. But the first year will be slower or less than projected. You can still recover. The thing is you have to actively get in there and put together a plan and a process. So with one outfit that I worked for, they've been at it for 20 years. They had a pretty well-oiled machine, and a lot of people like my knowledge in their processes. And I talk about that, and they say, "I want you to teach me how to do that." So I was an asset manager. I handled the transactions also, and during the due diligence period of, let's say, 60 to 90 days, all the value add plan and all the coordination and all the new teams and everything was done so that the day after closing, we had a new system, a new property management team, a new flag, a new signage, and everybody was off and running and they knew what they had to do. Meaning that the property management team, the construction team, everything was preloaded and set, and they were off and running. A lot of people who get this, they close and they take a breather and they say, "Oh, now what do we do? How do we implement this?" Well, they can get behind if they take too long, but a lot of times they can do it in a short amount of time. Get organized in 30, 60 days. But for most institutional grade people, there's really not a lot of room for error these days, given what they have to pay for these properties on the front
Mhm.
end. So they have to be very precise and very accurate on their timing and their costs on getting this done. And that is where the yield is. And the ones that are successful and able to do it are the ones who have the experience. They know exactly what it's going to take, and they don't have to spin their wheels to figure it out, so to speak. So having said that, there are a lot of units out there that are smaller in size, that a lot of newer people, let's say moving up from single family flips to rentals, to get into 10 plexes and 50 plexes, they still have to go through the same thing, only there's less competition and they can buy these properties for less. So if they're able to put together a creative plan and that fits a niche in a marketplace, they're able to have a pretty good investment then. And I would suggest, I see people new at the game who started out smaller units. That's a safe way to start out. I see people, and then they move up to institutional, and they do that. Institutional is 100 plus, and there's a lot of competition, meaning that the margins are skinnier and there's less room for error on that regard because you're competing with the REITs, the large owners, large portfolio owners, and they're able to do a lot of units. Let's say buy 200 to 500 units a year, and so they have to have a full team that's well coordinated. But believe me, there's a lot of people doing that, and a lot of people are being successful at it. So that's the goal of everybody. So and they soon realize that they need an asset manager or somebody's expertise who's done it before, because they can't do it all themselves because there's so many moving parts that they
Yeah.
are spread too thin.
Absolutely.
So you can see that we become the catalyst for growth. If they're able to hire an asset manager, it means they've already acquired, let's say, about 100 units, and that allows them to get better data and get better underwriting and better acquisitions. So we are the catalyst for growth, and the asset managers typically have the experience. They know what you can perform on, so they oftentimes overlap and become underwriters. They overlap and take care of the accounting with the accounting team involved. They overlap and take care of paying the bills. Real estate taxes are one also. So every line item in the expense of a T12 has its own strategy and its own skill set on how to manage to get the appropriate people in there. So that's where asset management show their value, is being able to hire, let's say, a real estate tax appeals consultant, how to hire the right landscaper, how to hire the right laundry provider, the pool cleaner. The property management company also has ideas, but that's also an opportunity to save expenses. So the asset managers are involved with that, and they make sure they get paid because it's critical for the tenants to have a working place that they don't have to do any maintenance on and come home to it each night. So
Yep.
the property manager should have a full-time staff there and of maintenance and leasing people that the tenants are comfortable being around with and can take care of their tenants. And then how can you say assemble the right mix? That's your secret sauce. You can duplicate that and take off, and everybody is able to get what they need and walk away happy. So it's
Yeah, it's
challenging
like
for some outfits.
putting together an orchestra. You got the brass, you got the string, you've got the choir in the back, and you get the percussion, and then once you get them all together, that's when you get a beautiful song. How are you seeing? So we're seeing year over year rent decrease growth, like negative growth in a lot of markets now. Um, Meanwhile, expenses are still increasing. Taxes in a lot of metro areas just out of hand. Insurance, same thing. But labor, construction costs. How are you seeing asset managers adapt to this market and from a say someone, and we're talking non-institutional here, adapt with current projects and then also adapt going into new projects to make sure that they can perform and hit their numbers.
Yeah, there's no question we're going through a correction, and all the things that you mentioned are a factor. So asset managers come in after the fact, after they're closed. They see that they may be missing their NOI. So maybe the market has changed, maybe the environment has changed around it from the time of underwriting. So they need to come up with creative ways to boost the NOI, add income, ancillary income, decrease expenses, and that helps cash flow meet your NOI. And for every $10,000 of savings or NOI that you can add, you cap that or divide it by 5.5 or 6, and that gives you about 180,000 more of justified value at the end, because the cap rate determines the valuation at the end.
Mm-hmm.
And in a simple way, that is how you justify your value, is that you meet NOI and you're able to adapt and adjust and help the owner meet that NOI creatively per plan or by just adapting and getting out in front of problems that the environment has changed around it. So right now, expenses are going up. That is a battle. Um, Rents have surprisingly during COVID have peaked and went higher, and now they're coming back down. So they're worried about how low that they will go, but they hope that 3% rent growth is the standard in the industry. They hope that they can maintain their 3% rent growth. Some markets have bounced up 10, 20% during COVID because everybody decided to rent and stay put. So that was a surprise. And how can you say it can be kind of a head fake. It can throw ownerships off saying, oh, we don't need to renovate. We don't have to do our value add plan because we got much revenue now that we're taken care of. Well, things are coming back down, and so they're having to adapt and adjust and change as they go in order to meet the expectations of the investors, what they were shown at the beginning, which was pre-pandemic, pre-recession, and still get it to work. So what we're seeing here, the ones who are able to perform and make their investors whole are going to be able to get reinvestment from those people.
Yep.
They're going to be able to get new reinvestment. But we're going through a period where, how can you say, the ones that didn't adapt and adjust are going to not be rewarded in the marketplace, and they're going to find it harder to continue. They may make some money on this first round, but they have to adapt or die, I guess. And that's kind of how
Yeah.
the American economy is put
that, that
together.
that's with everything. And I played that game with house flipping. It was a lot different back in 2011, 12. Going into 16 through 18, and then during COVID. So you're always adapting, and it's going to be interesting. I think on the rent rate, how that'll end up playing out, and there's so many factors there, but yeah, we just it accelerated so quickly in such a short amount of time that it's natural that we're going to see a year-over-year decline. Part of it's seasonal. The other part is just coming, gravity. And then we'll see how low that goes. But I would imagine that levels off. As long as labor remains strong and unemployment remains low, which the Fed's trying to work on that still. I'd imagine that still keeps it. But the concern that really wraps up into that equation is new supply coming on, and 2023 has one of the highest number of units coming online in like 40 years. So depending on your market and submarket, there could be a little bit more pain ahead.
Yeah, supply and demand in a market pretty much dictates what the rents will be. In a lot of cases, there's undersupply and new units are desperately needed, and it really won't affect, let's say, the value adds that were built in the 1980s. They're able to adjust in a small way. Sometimes the new supply will be more than it's needed, and they will compete and drive down rents so that they're not able to get what they projected. But the standard underwriting on rents growth is about 3% per year. Most markets in the Sun Belt, at least, are above that, but it's going to vary from market to market, and that's based on rent growth and everything. Another big surprise that happens is the rise of interest rates. The cost of money is about the biggest expense line item in a real estate budget because NOI pays the mortgage. And there's a debt service coverage that is contractual with the banks. And if you're below what's contractual, 1.25 in a lot of cases, you're on their scope.
Yep.
So you have to work with the banks. They're going to give you some concessions and work with you. But sometimes it's a threat because they have first lien rights on the security and they can foreclose and take it. And then the equity investors get nothing. All the equity is lost then. So that is a threat. And so asset managers provide more NOI to make sure the debt service coverage stays in the projections. For one, to keep the lenders off their back, so to speak. And one, to make sure their equity providers get the same returns that they were expecting. So that is the demand for people like me. We know how to increase NOI and get that reliability. So there's things like portfolio and supply and demand and adjusting for variances and everything else that, there's a strategy for each line item. Those are the types of things that we can see. We can spot the mini trends before they become big trends. And the big trends become, let's say, big variances, which are hard to correct and oftentimes expensive to correct. But if they go too long, they're not correctable and they can cause trouble. So
Yep.
right now, people are compensating for interest rates that were once, let's say, 3%, have gone to 6 and 7% because they were adjustable. And that's a big jump. So that means that the ability to pay the mortgage is impaired because the interest rate payment went up. So the properties that were locked in rates, you're able to assume loans from Freddie and Fannie from a prior year. You're able to purchase those and assume them. That makes them investment quality and more valuable. So the debt has a big impact on real estate holders. And as you well know, the homeowners right now realize that their personal budgets, because of interest rates, have gone from say 2,000 to 3,000 a month. It comes out of their pocket. Same thing times 100 for a 100-unit property.
Yeah.
So
Yeah.
everybody, the real estate industry has some challenges, but like I say, it is the guys who are able to underwrite appropriately and manage appropriately are going to survive this. The ones that got a little bit carried away are going to have some more troubles, but it is correctable.
Yep.
So
Yep.
I'll say that.
Good. Well, let's close out with a couple questions. I asked this to all the guests that come on the podcast. Starting off with question number one. If you could give advice to your 20-year-old self, what would that be?
Oh, that would have been, I wouldn't have done anything different, but having, hindsight being 2020, I would say that the 2000s are coming, the 2010s and 2020s. They've changed drastically. I would say that, let's understand the new culture of leadership and accountability for ahead. So I would have studied more uh, leadership type topics back then, and then built and continued to adapt and learn because things have changed drastically in the last 20 years.
That's interesting. It's a perspective I haven't heard before. I like it. What book or books have greatly influenced your life?
So right now, when you're young and 20, you don't think about that far ahead. You do the best you can with the information that you have.
Yep.
So if books like Extreme Leadership or Dichotomy of Leadership, or these leadership books written by Maxwell and all these others out there would have been extremely valuable at that point. Back when I was 20, the only way to get that type of leadership training was to enlist in the Navy or the military and go through the ranks. Right now, you have ex-Navy SEALs writing books and talking about all the things that you need to do to keep up with technology and the new things and to adjust and adapt. That's been critical in this new age post-COVID.
Yep.
So
And you were
back
talking
when
about
I was 20,
extreme ownership, right? Extreme ownership and the dichotomy of
leadership,
dichotomy of
yes,
leadership,
those
and
are
then
two straight to the point Jocko Willink books
yep.
that speak to it's a direct thing that the private sector needs to really get a grasp on and apply to the business world, taken straight from the Navy SEALs training. Um, it's a hard thing to get your mind around. As a 20-year-old, you don't have that type of load, that type of responsibility put on you that young. But as you get out into the business, you do. So it's good to get all the training and coaching and leadership training that you can get as you get out to the business world.
Love it. In the last 5 years, go ahead. Did you have something else?
So I would say in the last 5 or 10 years, these books have came out, and the leadership gurus, I call them, or the coaches, or the people who learn this at an advanced level and perform at a high level in the military, the Navy SEALs. They're finding customers in the business world who need this because technology, the economy, the business world has all changed, and they need this. They need to understand this and how to operate with this in order to grow, in order to even just to stay at even par at work, operating profitably. So You learn that on the fly. But my 20-year-old self, I did what I was doing at a high level young, but we still didn't have that type of training, and I wish we had.
Yeah,
So,
yeah. In the last 5 years, what new belief, behavior, or habit has most improved your life?
along that line there, leadership, I took a boot camp course with Raul Velasquez. He writes a book, but he also teaches. He has kind of a following, but 1%. The goal is to get 1% better each day, but perfection is really the lowest standard. You'll never get to perfection. You just have to get 1% better. And a lot of people in the business world get who are working in a career and so forth get loaded up to the point of failure and to the point where it taps their well-being. So this brings you back, learning meditation, taking care of yourself. Being an entrepreneur has a lot of demands. You need to be able to have a good carbon-based unit that's healthy and operating so you can adjust and expand with the demands out there in the world. So I think entrepreneurs working for yourself is a good test. So I have seen the American model where competition and the best survive really almost push human capabilities to its max and then some. Technology has grown a lot in the last 10 years. They say it's going to grow 100 times the next 10 years. So that is really affecting a lot of folks and their well-being, their mental health. So a lot of it is just being able to adapt and change and get up the learning curve.
Yeah,
And this 1% per day is something and saying healthy is what you need in order to get that, in order to continue to grow. You may have, the highest perfection level expectations, community, that you may have that on yourself or your employer may put that on you, but you need to really worry about yourself and getting better 1% per day because that's 37% per year. And that's a pretty good growth rate right there.
100%.
So, people are being pushed to their limits and are getting in having health troubles, and that's a problem in our society right now. They're turning to self-medication, whatever that is,
Yeah,
addictions. So the thing is, be as healthy as you can be and continue to grow.
yeah. And I would add having the self-awareness and the humility to know what your skills are and what they may not be and how you fit. Because at the end of the day, entrepreneurship is cool. It's a lot cooler than when I was 20, and definitely a lot cooler than when you were younger. But at the end of the day, not everyone needs to be an entrepreneur. Some people are much better being a number two or a number five in a startup, and they'll probably be happier, wealthier, more overall well-rounded. But
Yep. So the self-awareness is key. There are a lot of people out there who work. I've seen this earlier working for a large institutional life insurance company. These young people are told that they are high performance, they're all that in the bag of chips and they're perfect and and they believe that. Where if they're compared to entrepreneurs and so forth out in the real world, they may not be. So people have to have a broad base, a lot of checks and balances, and the humility and the awareness, and to be able to tap into all the feedback that life gives you so that you can adapt and adjust on a daily basis.
yep,
I hope that makes sense. But I see a lot of people who have the self-awareness thing, just see how you fit in the day to day with everybody else out there because the competition is steep. Um, you have to perform on a daily basis. So if you aren't aware of what standard you have to meet on a daily basis, you're at a disadvantage.
yeah,
So
yeah. And it's getting stiffer because a 14-year-old kid in Rwanda can come in and compete with you depending on what you're doing. And their version of success is a lot different than what yours might be if you live in Silicon Valley. Uh, so,
exactly.
how can people reach out to you?
So the best way, I guess, is I have a LinkedIn profile that's been up for 20 years or so. Andrew A. Pope. You can search and Google me. Preferred Systems is a company that I work with and do freelance and fractional asset management. So I'm doing consulting, and I help owners who want to grow. I become the change agent and the growth agent for their portfolio size because it pays. It's economically feasible to grow a portfolio of real estate and become financially independent. There's a big demand for that. Everybody wants to get to a point where they don't have to work, to the point of exhaustion every day, and have a life that they want to continue and pursue other interests. So that has been the theme right now, is to grow your portfolio, and asset managers help with that. We train with that, and we get people of the awareness and the system so that they can check their checks and balances and get 1% better a day in this industry,
Yeah,
which is
yeah, I think
important
you've clearly
because
illustrated how vital it is, just in general, but especially in a cloudy market with a lot of uncertainty ahead. It's vital to run a successful property, to fulfill your promises and projections that you have for your investors, to make sure you're fulfilling your obligations to the banks, and doing your job as an operator, like for your residents, is just so important.
Yeah, I've seen this before. When economies change and properties go bad, it affects the owner's life and their careers and their families. So, once they understand this, they're well vested and they take responsibility and leadership, and they want to do it right the first time. So that's where the value is that they don't want to fail. And we don't want, my job is to make them successful and not fail, and to stay ahead of it,
Yeah,
and to,
you're gonna make them look
so
good.
make them look good. So this is common sense stuff, but not everybody does it. And I just wanted to give my 2 cents.
Thanks for tuning in. If you got any value out of this at all, please like, comment, subscribe, follow. I'd love to hear from you. And for more real estate related content, market observations, upcoming events, you can go to investedx.com and subscribe to our weekly newsletter. I promise you won't regret it. Thanks again.